You're about to discover the secrets of the man who taught Warren Buffett how to invest, a genius who created the rules that changed the world of finance forever. His name, Benjamin Graham. The method, a strategy so powerful that it protected investors even during the Great Depression and remains relevant today. And the most impressive thing, you can learn how to use it too. But before I show you how to apply this, let me ask you, have you ever heard of someone who lost everything in the stock market by following rumors or tips from experts? It was exactly to avoid this type of error that Benjamin Graham created his method. While many people buy stocks just because everyone else is buying, Graham did the opposite. He believed in a thing called safety margin. And it is this single idea that made him the father of value investing and mentor to some of the world's greatest investors. But after all, how did this man create a method that still saves investors from losing fortunes today? To understand this, we need to go back in time. And I'll tell you everything in 3 seconds. Stay with me because this could change the way you invest forever. In the early 20th century, Benjamin Graham grew up in a family that lost almost everything when he was still a child. This was a very difficult time, as his family had to leave a nice home in New York to live in hardship. It was this experience that made him promise that he would never let money slip away because he didn't understand how the market worked. As he grew up, Graham proved to be a genius in mathematics. He graduated early from Columbia University, one of the most important universities in the United States. And while still very young, he started working on Wall Street, the famous financial street in New York. There, he quickly stood out for his ability to analyze companies in a way that almost no one else did, by carefully reading financial reports, comparing prices, and calculating the real value of businesses. But in 1929, everything changed. This was when the biggest stock market crash in history occurred, known as the Great Depression. Millions of people lost everything. Entire families were left homeless, unemployed, and without food. Banks collapsed and businesses went bankrupt. Fear took hold of people. Investors sold their shares in desperation, accepting any price. It was a chaotic moment. And Benjamin Graham, who also lost money, was not paralyzed like many. Instead, he began to study even more. He wanted to understand how to protect investors' money, even when everything seemed to be falling apart. It was then that he created the concept of safety margin. The idea is simple but powerful. Only buy a stock if it is being sold for a price much lower than the company's real value. This way, even if things get bad, you will still have protection against major losses. For Graham, this was like having a mattress that cushions your fall. And what's more, he said that the market is like a person he calendar. Market. This Mr. Market offers a price to buy or sell shares every day. But his mood is always changing. Some days he is super happy and wants to sell shares at sky-high prices. In others, he is depressed and accepts selling too cheap. Graham taught that we should not follow the moods of Mr. Market. On the contrary, we should take advantage when he is afraid and offers low prices, and resist the temptation to buy when he's too excited and stocks are expensive. This way of thinking completely changed the way people invested. Instead of betting or following tips, investors started looking at the numbers and fundamentals of companies. Graham also said that most of the time, the market is irrational. He is driven by emotions like fear and greed. But in the long run, the true value of companies ends up appearing. In other words, those who buy good companies at low prices and wait patiently usually come out on top. Want a simple example? Imagine that you discover that a company is worth 100 reais per share, but the market is selling at 60 reais because everyone is afraid. If you buy at 60 and wait, when the panic passes, the price returns to reflect the true value and you profit. Simple as that. But be careful. Graham never recommended betting on just one or two companies. He taught that it is necessary to diversify. That is, to have several different actions. So even if some go wrong, others will make up for it. This method helped investors protect their money even in severe crises. And the most incredible thing is that it was with these teachings that Graham wrote one of the most important books in the history of investments, The Intelligent Investor. In this book, he explains how to analyze companies, calculate their real value, and, most importantly, how to avoid falling into market traps. Warren Buffett, who would be his student years later, said that this book changed his life and made him understand how to invest safely and intelligently. But you must be wondering, how did Graham go about discovering the real value of a company? And how can you apply this today, even if you're not a finance expert? In the next block, I will tell you step by step how Graham analyzed companies and found opportunities that most people ignored. Stay with me, because this part is essential to start investing as the father of value investing taught. You've seen how Benjamin Graham learned the importance of safe investing after living through the Great Depression. But how did he figure out whether a stock was cheap or expensive? Let's break it down together, step by step. This is the true value of a company, based on its profits, the assets it owns, and how the business grows over time. First, Graham created a concept called intrinsic value. Graham's big secret was to compare the intrinsic value he calculated with the price at which the shares were being sold on the market. If the stock was selling for much less than it was worth, he called it a safety margin. This difference between the real value and the market price protected the investor, because even if something went wrong, the chance of losing a lot of money would be lower. But how can we calculate this in a simple way? Here's how Graham did it, and 6 reals. The average earnings would be 5.2 reals. One look at the company's average profit over the past few years. He added up the earnings per share for the last 5 years and divided by 5, finding the average earnings. For example, if earnings per share were 4 reals, 5 reals, 6 reals, 52 reals, calculate the intrinsic value. Graham multiplied this average profit by a number between 8 and 10. In the example, real 5.2x 10 are $52. This would be the fair value of the share. 3. Compare with current price. If the stock were selling for 30 reals and the calculated fair value was 52 reals, this would provide a margin of safety of over 40%. This margin is like buying a house worth $100,000 for just $60,000, even if you need to sell quickly. You still might not lose money. But Graham didn't stop there. He also analyzed whether the company had high debts. If the company owed much more than it could pay, he would stay away, because in a crisis, indebted companies can go bankrupt. Additionally, he looked at whether the company had stable or growing profits. If a company's profits go up and down a lot or have frequent losses, this shows that the business may be risky. Another essential principle of Graham's was not to invest in businesses he didn't understand. If he couldn't explain in a few words how the company made money, he preferred not to invest. For example, if he understood how a soda factory made money but couldn't understand a very complicated technology company, he would simply ignore it. Graham also said it was very important to diversify investments. He recommended having between 15 and 30 different companies in the portfolio from different sectors. So even if some actions didn't work out, others could make up for it. This diversification strategy helps protect your money because it greatly reduces the risk of losing everything. Another point that Graham always highlighted was don't let emotions take over. When the market goes up a lot, many people buy expensive stocks for fear of missing out. When the market falls, people sell their stocks in panic. This emotional behavior causes many investors to lose money. Graham said investors should stay calm, study the numbers, and make decisions based on facts, not fear or greed. What if you don't have the time or patience to analyze companies individually? Graham said that, in this case, investing in index funds, which buy shares of several companies at the same time, can be a great option. This way, you invest in many good companies at once, without having to choose each stock individually. These teachings led Benjamin Graham to be recognized as the father of value investing. He not only helped ordinary people protect their money, but also taught great investors like Warren Buffett. And Buffett always said that Graham was the one who most changed his way of thinking and taught him to invest intelligently and patiently. But does Graham's method still work today, in a world so different from his? The answer is yes. The market is still full of investors who buy and sell based on fear or euphoria. The most important moment has arrived: learning how to apply all of this in practice, even if you are just starting out. And that's where opportunities appear for those who have patience and discipline. In the next block, I will teach you how you can apply all of this in a practical way, step by step. To find good companies, calculate the safety margin, and build a safe and profitable portfolio. Stay with me, because this part can completely change the way you invest. Now that you know Benjamin Graham's story and understand how he calculated the value of companies, the good news is that you don't need to be a financial expert or have a lot of money to start investing as Graham taught. You just need to follow a few simple steps and have the discipline to put them into practice. Let's go. Step 1. Find profitable and reliable companies. First of all, look for companies that have had stable and growing profits over the past few years. Companies that consistently make a profit show that they have a strong and healthy business model. This will give you an average that smooths out bad or very good years, making your analysis more realistic. For example, if the earnings were $4, $5, $6, $5, and $6, the average would be $5.20. If the average earnings were $5.20, the fair value would be between $41.60 and $52. This will give you an idea of how much the stock should be worth based on the company's fundamentals. You can see this in the financial reports available on websites like Yahoo Finance or investing.com. Step 2. Calculate the average profit over the past few years. If, for example, it's trading at $30 while the fair value you calculated is $50. That means there's a 40% margin of safety. This is exactly what Graham was looking for: companies selling for far below their true value. Add up the earnings per share for the last 5 years and divide by 5. Step 3. Estimate intrinsic value. The goal is to buy good companies at low prices and hold the shares for years until the market recognizes the true value of these companies. Graham often said that companies with too much debt may look good, but they are dangerous. Make sure that the debt is less than the company's profits and assets. If the debt is too high, run away. Use these dividends to buy more shares. This accelerates the growth of your wealth without having to invest more money from your own pocket. Graham said never to make decisions based on fear or euphoria. Instead, use the declines as an opportunity to buy more, as long as your analysis shows that the company is still sound. That way, if one company doesn't do well, the others can balance it out. This protects your assets and prevents one mistake from wiping out your entire investment. But if you follow these principles, you can build a solid portfolio that is prepared for crises and capable of growing in the long term. Multiply the average earnings by 8 or 10, which is the multiple Graham used as a basis for stable companies. The more knowledge you have, the better prepared you will be to make good decisions. Step 4. Compare with the current market price. Once you've estimated fair value, look at what the stock is trading at today. Step 5. Analyze the company's debts. One of the most common mistakes investors make is ignoring debt. Step 6. Build a diversified portfolio. Graham recommended investing in several companies between 15 and 30 from different industries. Because in the next video, I'll tell you how Benjamin Graham helped Warren Buffett turn small savings into billions of dollars, and how you can also use this strategy to change your financial future. Step 7. Patience is key. Graham's greatest lesson was patience. His method is not for those looking to get rich overnight. Step 8. Reinvest dividends. Profitable companies often pay dividends, a portion of their profits that go directly to you. Step 9. Don't panic about market fluctuations. The market will go up and down, and you will see prices rising and falling constantly. Step 10. Keep learning. Last but not least, always study. Read books like The Intelligent Investor, follow company reports, and learn about economics and finance. These steps sum up Benjamin Graham's philosophy, which protects investors to this day and has helped build fortunes safely. And remember, investing safely is a path that requires patience and discipline. Now I want to know from you. Do you already invest? Do you ever use the concept of margin of safety to choose your stocks? Comment below, because I'd love to know how you are evolving as investors. And if you liked this video, subscribe to the channel and activate the bell. See you in the next video.